Okay, let's unpack this. Have you ever wondered if the advice you're getting about building wealth is actually maybe slowing you down? What if much of what we've been told about getting rich, well, what if it's not just ineffective, but maybe even
No.
preposterous? Today, we're doing a deep dive into the material you've provided from Omar Johnson's The Simple Path to Wealth series.
Hmm.
His core mission, it seems, is to give you a shortcut, right? A shortcut to being well-informed on building wealth fast, multiplying it, preserving it, and challenging a lot of that, conventional wisdom.
Right. And what's truly fascinating here from the get-go, really, is that this deep dive explicitly challenges those widely accepted financial norms. It offers a blueprint for rapid wealth accumulation that really goes against the grain. It's not just outlining that slow, steady path we always hear about. So our mission today is to extract the specific, sometimes unconventional insights behind these immutable laws he talks about, and uncover what the wealthy really know and maybe do that others don't.
Okay, here's where it gets really interesting. Like right off the bat, the author claims strategies like, say, saving 20% of your paycheck or, patiently investing in the stock market for 40 years. He says these are totally unrealistic for becoming wealthy. He even says 401ks and mutual funds won't make you wealthy. Now, that's a pretty radical claim. What exactly is the fundamental flaw he's seeing here? Is it just that it's slow? Or is he saying these tools are, like, inherently bad?
Yep,
Or just inefficient for his definition of fast wealth?
Well, it's not that they're bad tools exactly, not in a vacuum, but for rapid wealth creation. They just don't have the necessary accelerators. The author argues the mindset behind these slow approaches, especially that whole living below your means idea, actually creates what he calls psychological prisons.
Yeah.
So instead of fostering true wealth, it cultivates a scarcity mentality. And the really profound insight here, I think, is about your deepest beliefs about money, often unconscious ones, your money blueprint. He says that's like a hidden ceiling on your wealth. Until you confront and, reprogram these views, often formed in childhood, true wealth creation is basically out of reach. Your subconscious will actively, repel it.
Wow, that's a powerful idea. That our own subconscious beliefs are the real hurdle. Can you give us a sense of what that actually looks like in practice?
Absolutely. Yeah, the source gives some really powerful examples, like Sonia, who develops this unconscious money avoidance because her grandmother used wealth to control the family, or Jackson, whose father's comment, filthy money, led him to subconsciously find ways to get rid of any wealth he managed to accumulate. The author really stresses this. If you believe wealth is inherently evil or dirty or whatever, you'll unconsciously sabotage yourself every time. You simply have to address these subconscious issues first. That's foundational.
Right. Okay, so once we've maybe started to reset that inner money blueprint, what's the first practical step towards actually building this wealth? The author introduces what he calls the law of control. He argues that when you're working a job, you have very little control over your time, right? And you'll never get wealthy this way.
Right.
Because, and this seems key, income does not equal wealth.
Mm-hmm.
So what does he propose instead? How do ordinary people, maybe people still working a 9 to 5, start applying this law?
Yeah, he makes a really sharp distinction there. Income is what you get paid for your time, sure, but wealth is about owning assets, things that appreciate or generate income independently of your direct labor. He points to examples like Steve Jobs and Steve Wozniak. They started Apple in their spare time, right, while they were still employed elsewhere.
Yeah.
So the lesson isn't necessarily quit your job tomorrow. It's more about starting to create something you own, something with real equity, maybe in your free time. And he strongly critiques passive stock investing for this reason. As a typical shareholder, he argues you have absolutely no influence or control over how that company actually makes money.
Right, you're just along for the ride.
Exactly. Unless you're an activist investor like Carl Icahn. He mentions Icahn made, $825 million in 14 months from Netflix by actively influencing decisions. Or an owner like Mark Zuckerberg, who had 56.9% of Facebook's voting power. He famously rejected Yahoo's $1 billion offer.
I remember that.
Which led to Facebook's, massive $196 billion valuation later. So the author's point is, be a seller of shares through an IPO you created, not just a passive buyer in the market. It's about ownership and control.
That's a huge shift in perspective, focusing on ownership, on control. Okay, so if control's the engine, what's the fuel? What truly multiplies your efforts according to this?
Well, if we connect this to the bigger picture, control ties directly into the second law he talks about, leverage. And leverage is simply using other people's time, other people's knowledge, other people's money, systems, and technology to accomplish more than you would by doing it yourself. Think of that Hercules analogy he uses. Can't move a 900-pound rock alone, right? But with a lever, you can. That's the power of leverage.
Okay, makes sense.
So in real estate, financial leverage means getting a bank loan to buy a rental property. Then you use the tenant's rent to pay down the debt. You're conserving your own capital. The source even mentions some non-conventional stuff, like quick-turn real estate investing, which involves finding creative solutions for motivated sellers, often without risking your own money up front.
Interesting. And in business?
In business, leveraging means hiring employees or outsourcing tasks to multiply your efforts, and creating automated business systems for marketing, sales, fulfillment, administration systems that allow a business to essentially run on autopilot. J. Paul Getty famously said he'd rather have 1% of the effort of 100 men than 100% of his own effort.
Right, classic.
And look at the Forbes 400 list. It's dominated by business owners who masterfully use leverage. He cites Jeff Bezos leveraging the internet for Amazon, Phil Knight leveraging athlete star power for Nike, even Donald Trump leveraging banks' money for real estate. And the author also stresses why scale is essential, the ability of a business to grow without limit. Think Walmart, think Domino's. That's leverage and scale working together.
Okay, so we've got control, we've got leverage multiplying our efforts, but all that power needs direction, doesn't it? Which brings us to, well, what value are you actually delivering? This leads to the law of value and service. It sounds simple. The more value that you create in the marketplace and the more people that you deliver this value to, the wealthier you will become. But what exactly is value, and how do you deliver it in a way that actually stands out from the crowd?
Value, as the source explains it, it's fundamentally based on perception. You create it by identifying existing market wants and needs, or sometimes by being a visionary, like he says Steve Jobs or Jeff Bezos were. Think about the Kindle ebook reader. That disrupted the whole publishing industry, right? By creating demand where maybe it didn't really exist before or wasn't obvious. The key, he argues, is differentiation. And having a unique selling proposition, a USP, that's what sets your products or services apart from your competitors.
Okay, USP, like those classic taglines.
Exactly. Think of Federal Express. When your package absolutely, positively has to get there overnight, that's a powerful USP. Or Domino's Pizza. You get fresh, hot pizza delivered to your door in 30 minutes or less, or it's free. M&Ms. The milk chocolate melts in your mouth, not in your hand, another classic. And he highlights Zappos, too. Their offer of two-way free shipping and those, 365-day returns, that's presented as a powerful risk reversal. It completely differentiates them in a commodity market, like shoes. So it's really about solving a problem or fulfilling a desire in a unique, compelling way. That's perceived value.
That makes perfect sense. Identify a need, fill it uniquely. But an idea, I mean, no matter how great, is still just an idea, right?
Yeah.
How does the author connect this back to actually creating the wealth?
And this is where it gets really practical, the law of execution. The source explicitly states that without execution, wealth creation is impossible, full stop. Thomas Edison famously said, vision without execution is hallucination.
Right, heard that one.
An idea, he says, is worth nothing unless executed. They're just a multiplier. Execution is worth millions. And he gives examples of what he calls so-so ideas that were just brilliantly executed.
Right.
Like Ron Popeil, the as seen on TV guy.
Yeah, the pocket fisherman.
Exactly. He apparently made over $1 billion from quirky products like GLH hairspray and the smokeless ashtray. Why? Because he executed relentlessly on product creation and marketing. You don't necessarily need a completely original idea. Google improved on Alta Vista. Facebook improved on MySpace and Friendster. The lesson is clear. Just improve on an existing idea or add something new, and then execute relentlessly. That execution piece, that's the real magic, according to this.
Okay, relentless execution. That really leads perfectly into the next one, doesn't it? The law of speed and acceleration. The author directly challenges that whole get rich slowly philosophy. He calls its tenets utterly preposterous. Now, for many of us, the idea of saving part of our paycheck, putting in a 401k, that's the only path we've ever really been told about. So why does he advocate for such speed and wealth building? And why does he say things like, working on a job and saving money from a paycheck will never make you wealthy? That sounds harsh.
It does sound harsh, but his argument is about efficiency and multipliers. He argues that 401ks and mutual funds are inherently the slow way because they offer very limited multipliers and almost no control for the individual investor. He contrasts them with vehicles like hedge funds, which he calls one of the fastest ways to create, grow, and accelerate your wealth. Why? Primarily because of their aggressive use of leverage. Think of his car analogy. If your current wealth-building vehicle, maybe your savings plan, can only go 70 miles per hour, you need to change to one that can go 200 miles per hour if what you truly desire is speed.
Change the vehicle, not just press harder on the gas of the slow one.
Precisely. And he really pushes back on things like clipping coupons, being frugal, living below your means. He argues these are just expressions of a scarcity mentality. Instead, he says, focus your energy on expanding your means. Focus on exploding your income. It's about changing the vehicle and the entire mental framework around money.
Okay, expand your means, get a faster vehicle. And once you've picked up that speed, how do you keep it going? How do you turn it into something, well, unstoppable?
Right, that's where the law of momentum comes in, which is, a term from physics, defined as mass in motion. It reflects the quantity of motion an object has. The source uses the example of writing the book itself. It wasn't just one action, it was one successive action after another, building from the outline to the introduction to the full book, and then continuing that momentum with distribution, marketing, even licensing foreign rights to, as he puts it, print money. This is how its snowball effect can become an avalanche of wealth. This law really highlights how effectively combining the other laws, control, leverage, value, execution, and speed, how that combination multiplies your efforts exponentially. It creates that immense, unstoppable momentum toward wealth.
Okay, so we've built wealth fast, we've got momentum, but, fortunes are won and lost, right? Once you've built this empire, how do you actually keep it? This brings us to the law of wealth preservation. Putting a fortress around your empire, as he says. We insure our cars, our homes. But what about our wealth? He points to the 2008 financial crisis. Many people heavily invested in 401ks, mutual funds. They just got creamed, lost trillions. Because those vehicles often aren't insured against market crashes, and they have all these sometimes hidden fees that just eat away at your wealth.
Yeah, and the source makes a stark point here. Wealth cannot be destroyed, it can only be transferred, and often it gets transferred to Wall Street institutions. So the wealthy focus on preventing that unwanted transfer.
So how do they do that? How do the wealthy prevent that transfer? What's in the fortress?
Okay, so what are the specific strategies? What builds this fortress? First, the source points to specific financial strategies like protective put options.
Right.
I can think of it like buying an insurance policy for your stocks. It gives you the right to sell them at a certain price, even if the market tanks. It limits your downside risk.
Okay. Like insurance.
Kind of, yeah.
Yeah.
Beyond that, they emphasize hedging. Hedging against inflation, hedging against the declining value of the U.S. dollar. How? By investing in precious metals, specifically gold and silver. Gold's historical performance as a hedge, its nature as real money, unlike, fiat currency. That's highlighted. And then there's asset protection using legal structures. We're talking corporations, LLCs, limited partnerships.
The legal shields.
Exactly. They limit your liability. They separate your personal assets from your business assets. Unlike being a sole proprietor where you have unlimited personal liability and everything you own is potentially at risk if the business gets sued, these structures act as crucial liability shields.
Makes sense. And what about, the elephant in the room? Taxes.
Right. He calls taxes the greatest deterrent to building wealth. And the wealthy don't just, pay their taxes like everyone else. They hire accountants who really understand the tax code, understand the legal loopholes to minimize or sometimes legally avoid taxes altogether. It's a pretty stark revelation in the source that average working employees often end up paying more in federal income taxes than some massive Fortune 500 companies.
Wow. How is that even possible?
Well, one strategy revealed is the use of corporate tax havens. Companies park their profits overseas in places like Zug, Switzerland, or Dublin, Ireland, where corporate taxes are significantly lower. Sometimes it's just through mailbox companies that exist primarily on paper, maybe just to hold intellectual property there. It's a powerful legal way the wealthy minimize their tax burden globally.
Okay, so legal structures, tax strategies, anything else?
Yes, trusts. The strategic use of trusts is huge, like the Grantor Retain Annuity Trust, or GRAT. He mentions it was famously used by Mark Zuckerberg and Dustin Moskovitz with their pre-IPO Facebook stock. Allowed them to pass incredible wealth on, essentially tax-free, or using land trusts for privacy and anonymity when owning real estate. It all comes back to that Rockefeller quote the source uses. The secret to success is to own nothing but to control everything. Control, even in preservation.
Own nothing, control everything. That's a complete game changer when you really think about it. But, so much of what we've discussed seems to assume a pretty high level of financial understanding. The author argues quite strongly that our educational system leaves most people financially illiterate. Why is that such a massive problem, and how does it make people, vulnerable?
It's a huge systemic issue, he points out. Being financially illiterate means you just can't read the numbers. You don't understand the basic relationship between income and expenses or assets and liabilities. And this leaves you incredibly vulnerable, right? Vulnerable to those who do understand these things. The source really breaks down the core difference. An asset puts money in your pocket. A liability takes money out of your pocket. Simple, but profound.
Like the iPhone example.
Exactly. An iPhone is a liability, takes money out. Even a house you live in, he argues, is technically a liability despite conventional wisdom because it takes money out for mortgage, taxes, upkeep. Now contrast that with a house you rent out. That becomes an asset because it puts money in your pocket, and its mortgage becomes good debt. The source really emphasizes that understanding basic financial statements, the income statement, the balance sheet, the statement of cash flows, is absolutely crucial. You need that literacy to make financially intelligent decisions.
Okay, so financial literacy is key. But then he throws another curveball, the true nature of money. He claims that since 1971, when Nixon took the U.S. off the gold standard, the U.S. dollar became a fiat currency, meaning money that is backed by nothing, and it's essentially debt. He highlights Federal Reserve notes as just IOUs. He literally says, money is debt.
Yeah.
So if money is debt, and the Federal Reserve just prints more of it, like during the Great Recession, bailouts, quantitative easing, what does that mean for the average person just trying to save money?
It means, according to the author, that every time the Fed prints more money, it inevitably devalues the money that is already in existence. Inflation, basically, driven by currency creation.
Right.
And this is the core reason, he argues, why savers become losers. You simply cannot save money faster than the Fed prints it or faster than its value erodes.
Wow, savers become losers. That's bleak.
It is bleak if you're only saving. So the rich, understanding this fundamental truth, they choose to be big investors rather than big savers. They prioritize putting their capital into things that appreciate or generate income assets, rather than letting it just sit there in a depreciating currency.
Okay, so saving is a losing game long-term in fiat currency. We need to invest. But how do the rich properly analyze these investment opportunities? To find those fast-track ones we talked about. The source gives a kind of formula, right? A multi-step process.
That's right, yeah. It's like a checklist they run through for evaluating any opportunity. First, step 1, determine the overall security of the investment. Is it safe? And the source explicitly warns here about con artists, mentions shows like American Greed, examples like Bernie Madoff. The takeaway is, if an investment sounds too good to be true, it probably is. Due diligence is critical.
Okay, safety first. What's next?
Second, determine the liquidity of the investment. Basically, how quickly can you turn this asset back into cash if you need to? He contrasts liquid assets, like stocks you can sell easily, with illiquid assets, like real estate, which can take time to sell. Liquidity matters.
He's got it. Third,
determine the velocity of the investment. This is interesting. It's about how fast you get your original invested capital back so you can reinvest it somewhere else. Speed of capital return. The rich, the source claims, primarily invest for cash flow, not just for capital gains down the road. Getting their initial investment back quickly is a key goal.
cash flow and velocity. Okay, and the last step.
Fourth, determine the profitability of the investment. What's the actual return on investment, the ROI? And importantly, when can you expect payments? Is it daily, weekly, monthly, annually? Predictability of profit. And the source also briefly mentions using financial ratios, liquidity ratios, profitability, leverage, efficiency ratios as deeper tools the financially literate use to really analyze businesses before investing.
That's a solid framework.
Yeah.
Safety, liquidity, velocity, profitability. Okay, now this brings us to compound interest. Often called the eighth wonder of the world. Einstein supposedly said that. But the author here has a very different, maybe more critical take on it. What's the surprising truth, according to him?
Yeah, the common understanding, or maybe the common selling of compound interest is often misleading, he argues. While it's a great thing in theory, that traditional get-rich-slowly narrative, invest $1,000 at 10% for 40 years, magically get $452,593.
Yeah, the classic example.
Right. He says that ignores crucial variables. First, the massive amount of time required. If you start at 40, you're 80 years old when you see that big number. It also ignores the need for consistently high interest rates, year after year without any interruption. And crucially, it ignores the devastating impact of market crashes. He points to 1987, 2000, 2008. These events wipe out previous gains and completely halt the compounding process, setting you back years, sometimes decades.
So the smooth upward curve isn't realistic.
Not according to this? No. And he uses Warren Buffett as an example. Buffett isn't just patiently compounding. He's highlighted as an activist investor, someone who gains control of companies he invests in, like the Washington Post or Geico. And he uses financial leverage, like the insurance premiums collected from his companies, like Berkshire Hathaway, to acquire more companies. That enables astronomical, relatively uninterrupted growth. It's active control and leverage, not just passive compounding.
That's a key difference. It's not just waiting.
Exactly. And this also connects to the concept of accredited investors. These are people defined by law, basically, as having a net worth over $1 million or a high annual income. And the crucial point here is that these individuals have legal access to a whole different class of investment opportunities. Things like unregistered securities, private equity, hedge funds, investments that often have much higher potential returns, accelerating wealth much faster. These opportunities are simply unavailable to the average retail investor. It starkly illustrates how the system itself offers different speed lanes for wealth acceleration based on your existing wealth or income.
Wow, that's quite a realization. Wealth isn't just about what you know, it's about the opportunities you can actually access and then how actively you pursue them. Which brings us back, maybe full circle, to that stark reality the author paints. 90% of the people own 10% of the wealth, and 10% of the people own 90% of the wealth. He says this huge discrepancy isn't random. It's down to factors like drive, vision, know-how, execution, and having a superior financial education. Okay, so what does your personal financial thermostat have to do with landing in the 10% versus the 90%?
The financial thermostat, it's such a powerful metaphor, isn't it? It represents that subconscious limit people place on their own income and wealth. It causes them to kind of self-regulate or even unconsciously self-sabotage to stay at a comfortable, ingrained set point. So if your internal thermostat is set for, say, $50,000 a year, you'll likely find ways to hover around that level. Even if bigger opportunities arise, you might feel uncomfortable earning much more. So the source advises you have to continuously reset your financial thermostat or simply obliterate it in order to reach greater levels of wealth. It's about recognizing and then consciously breaking through those self-imposed mental limits.
Obliterate the thermostat. Okay, so it really does all come back to mindset, doesn't it? How does this then connect to those broader, maybe more esoteric, universal principles the author brings in, and also more practically to how we manage our most precious resource, our time?
Right. Beyond the practical laws of wealth, the source does delve into these universal principles that kind of reinforce the mindset shift. Things like the law of vibration, suggesting that balancing your internal energy, positive and negative, actually attracts money. Or the law of compensation, which states that you attract every experience that you have, good or bad, based on your actions and your efficiency. If you feel abundant, the source asserts, then abundance finds you. It's really about living life deliberately, consciously, not just reacting by default.
Feel abundant to become abundant.
Essentially, yes. And this connects directly, and maybe surprisingly, to time. Because the real mind shift the author pushes here is this, that common saying, time is money, he calls it a dangerous fallacy. Money lost can potentially be earned back, right? But time. Once a minute is spent or lost, it's gone. Forever. There's no getting it back. This reframes everything. Time becomes the most precious and valuable thing that you have, and it explains why successful entrepreneurs guard their time so ruthlessly. They recognize it as their ultimate non-renewable resource. Their productivity is where their earnings come from.
That's a huge distinction. Time isn't money. It's
Right.
much more valuable.
Yeah.
So if time is our most precious asset, how do we protect it? How do we maximize its value, according to this?
Exactly. Well, first, realize how much is wasted. The source claims most people are only truly productive for about 1/3 of their working day.
Ouch. Only a third.
Yeah. So it explains how to calculate your true hourly value by factoring that in. His example, if you aim for $96 an hour, but you're only productive 13 of the time, your real billable rate needs to be $288 an hour to actually hit your financial goal. Then it identifies these insidious time thieves, chatty colleagues, pointless meetings, people constantly asking questions, and interruptions, phone calls, texts, emails popping up, family distractions, even getting sidetracked by news items, all significant drains on productivity. So the strategies offered are about locking them up. Things like schedule meetings only at the end of the day, have specific times for phone calls, don't just answer whenever, use separate email accounts maybe, close your office door, and crucially, delegate administrative tasks to employees or assistants who earn less per hour than your calculated true hourly value. Protect your high-value time.
Locking up the time thieves. I like that. And what about the biggest internal time thief? You know the one, procrastination.
Ugh. Yes. Procrastination. The source calls it out as a serious productivity killer, obviously. It leads to a significant loss of productivity. Some strategies mentioned to fight it include writing down your daily tasks, maybe in a journal, breaking down huge projects into small, manageable increments, and having external accountability, someone checking in on your progress. Ultimately, though, the author circles back to mindset. He emphasizes that being positive is a choice and that you attract the energy you put forth. It's about taking personal responsibility for your actions, your energy, your focus.
Makes sense.
He also warns against playing the what-if game, that negative spiral of thinking rooted in unhappiness and regret. What if I'd done this? What if that hadn't happened? He says you have to stop playing that game immediately, convert it into positive, future-oriented thinking. And he reiterates, money won't make you happy. And also, interestingly, needing money won't attract it. Instead, you need to differentiate between your wants and your actual needs and then focus on positive, deliberate action towards your goals.
Wow. Okay, we have covered so much ground today, from challenging these really deeply ingrained beliefs about wealth, things like saving slowly, living below your means, to understanding the true nature of money as debt, the importance of financial literacy, and then diving into these immutable laws that seem to govern wealth creation and preservation. Control, leverage, value, execution, speed, momentum, and preservation. This really wasn't about quick fixes, was it? It was about a radical shift in perspective. And in action, it's genuinely a deep dive into what the wealthy apparently do differently.
Absolutely. And I think this deep dive really reveals that true wealth, according to this perspective, isn't merely about accumulating stuff or even just assets on a balance sheet. It's about mastering control. It's about leveraging resources effectively. It's about truly valuing your time and your unique contribution to the marketplace. And it's about aligning your inner blueprint, your mindset, with the flow of these universal principles that seem to reward focused action and positive intention. So maybe the challenge for you, the listener, is to consider this. If wealth is fundamentally about the efficient creation and transfer of value, what specific value are you creating in the marketplace right now? How relentlessly are you executing on your vision? And perhaps most importantly, are you truly honoring your time and your energy as your most valuable, absolutely non-renewable resources?